Most employees are told the same thing. RSUs are free money, and the taxes are automatically taken care of for you. But here's the truth almost no one talks about. For the majority of people, RSUs create hidden tax problems that lead to surprise tax bills, higher than expected withholdings, and sudden losses when the stock price moves at the wrong time. In this video, I'm going to break down exactly how RSUs are taxed, the 3 major tax traps you need to watch out for, and the strategies that actually help you keep more of your vested income. And by the end, you'll know exactly how to manage your restricted stock units so you don't get blindsided at tax time. RSUs are often pitched as one of the easiest forms of compensation. You work for your company, shares vest automatically, the company withholds taxes, and you simply keep the rest. It sounds clean, controlled, and effortless. And because RSUs show up without you doing anything, it creates the illusion that they are handled the same way a payroll check is handled. But the moment you examine how RSUs are actually taxed, that illustration falls apart. RSUs are taxed based on their fair market value at the precise moment they vest, not when you sell them or when you decide to take action. That means your tax bill is tied to a single snapshot in time, and you're responsible for that tax bill even if the stock price crashes immediately afterward. And to make it worse, most employers only withhold 22% for federal taxes, which is too low for a huge percentage of workers in industries such as tech. When the tax withholding is wrong from the start, and when the taxation depends on market prices you can't control, RSUs stop looking simple. They start looking like what they actually are: compensation that requires planning. And the problems don't stop there. In fact, RSUs create 3 major tax traps that most people only discover after they owe money. When RSUs vest, your employer withholds taxes using the supplemental wage rate. For most people, that's 22%. If your total supplemental wage across the year exceeds $1 million, the IRS requires withholding at 37%. But for the majority of employees, especially employees below the executive level, the company withholds the lower 22%. And that automatically creates a problem if your true tax bracket is higher. Most RSU holders fall into 32, 35, or 37% tax brackets. So when the employer only withholds 22%, that leaves a 10 to 15% gap. The employee doesn't see the gap until tax time because the pay stub gives the illusion that taxes have been already taken care of. The truth is that the company only satisfies the IRS minimum, not the actual amount you owe. This is why so many people receive RSUs and end up shocked with a bill of several $1,000s or even tens of thousands. It's not because they mismanaged anything. It's because the system is designed in a way that almost guarantees underpayment unless you fix it manually. And most people don't even know what they need to fix it. But even if you solve the withholding problem, the second trap quietly pushes your overall tax burden even higher. When your RSUs vest, the entire market value of the shares are added directly to your taxable income. You don't get to spread that income out. You don't get to defer it, and you don't need to sell anything for that taxable income to appear. It simply shows up on your W-2 as if it were cash bonus. For many employees, this sudden bump in income can change their entire tax profile for the year. Crossing into a higher tax bracket isn't the only problem. RSUs can push your income above key IRS thresholds. For example, you could trigger the additional Medicare tax at $200,000 of earned income. They can push you into the range where the net investment income tax applies, which adds an additional 3.8% on certain investment actions. RSUs can even reduce your eligibility for certain tax benefits and deductions. All of this happens silently and automatically. The real danger is most employees have no idea which threshold they're crossing until after the year has ended. They simply see the final tax bill and wonder how it got so high. RSUs have a way of inflating income in a way that doesn't feel like income. And that creates a disconnect between your financial reality during the year and the number you're stuck with at tax time. But even those first 2 traps don't compare to the third one, the trap that quietly drains the most money from RSU holders every single year. The most painful RSU trap happens after the vesting date. When your RSUs vest, your tax obligation is set in stone, based on the market price at that moment. But stocks don't stay still. They fluctuate constantly. That means your tax bill might not even match the actual value of your shares by the time you sell them. And if the stock price falls, that mismatch can be devastating. Imagine if your RSUs vest at $100 per share. You owe ordinary income tax on that value. But over the next several months, that stock drops to 80, then 70, then maybe even lower. If you sell at $70, you're effectively paying tax on $100 of income while only receiving $70 of real cash. The IRS doesn't care that the value disappeared after the vesting date. They've already taken their share. This is why many employees lose money without understanding what went wrong. They think, I paid the taxes, so I should be fine. But the tax happened when the stock was worth more, and the loss happened afterward. Unless you sell immediately or follow a disciplined plan, you end up with a risk you never intended to take and a tax bill that's completely out of your control. Now, if I talked about every mistake you can make with RSUs, this video would be hours long. If you want to understand every single rule, opportunity, and hidden mistake around equity compensation, you can download my free book using the link below. You'll learn everything you need to know about RSUs and stock options. So now that we've covered the biggest mistake to avoid with RSUs, let's talk about the tax optimization strategies that can help you maximize the real value of your RSUs. The most effective RSU tax strategy is surprisingly simple. Sell your shares immediately when they vest. The minute your RSUs vest, you've already triggered the tax event. The IRS treats it like the company handed you cash equal to the market value of the shares, and you owe ordinary income tax on that amount. Selling right away means you lock in the value you were taxed on and eliminates the risk that the stock price would drop. A lot of employees hesitate to sell immediately because they feel emotionally attached to their company, or they worry that selling signals a lack of confidence. But selling your RSUs isn't a commentary on your company. It's a smart financial decision. RSUs are not like stock options, where you choose the timing of taxation. RSUs tax you upfront whether you want them or not. Holding them afterward only adds investment risk without adding tax benefit. By selling immediately, you remove the volatility and convert your compensation into real dollars you control. You can invest those dollars in a diversified portfolio, set aside cash for taxes, or use the money for financial goals. The point is that you're finally in control. You're no longer gambling with compensation that has already been taxed. Strategy 2. Increase your withholding or make estimated payments. Since most companies withhold only 22% federal tax on RSU income, it's almost guaranteed that you'll owe more if you fall into a higher bracket. Rather than waiting until tax season to discover the shortfall, you can proactively fix it by adjusting your withholdings at work or making quarterly estimated tax payments. Increasing your W-4 withholding is the simplest method. You can raise the amount withheld from every paycheck, which helps compensate for the underwithholding on your RSUs. This approach spreads your tax payments evenly throughout the year. It also reduces the risk of penalties for underpayment because the IRS expects taxes to be paid as you earn income, not in one lump sum. If you prefer to keep more of your regular paycheck, you can instead make quarterly estimated payments directly to the IRS. This gives you more control and it allows you to match your tax payments more precisely with your vesting schedule. The key is not to ignore the shortfall. When you fix your withholdings, you eliminate the most common RSU tax surprise employees face. Strategy 3. Maximizing pre-tax contributions. RSU income counts fully towards your taxable wages, which means it can inflate your adjusted gross income and push you into a higher bracket. But every dollar you contribute to pre-tax accounts reduces the taxable income on your return. This includes your 401k, your HSA if you have a high deductible health plan, and even your flexible spending account. This strategy works especially well in the years when you have large vesting events. For example, if you know you have a major vesting coming up in the spring or fall, you can front load your 401k contributions so that the tax reduction lines up with the RSU income. This can help keep you out of higher tax brackets and protect you from additional Medicare taxes. It's one of the few levers you actually control when dealing with RSUs. Maximizing pre-tax contributions also helps you in the long run. Not only does it reduce taxable income today, but it increases your retirement savings. Because RSUs are so rigid from a tax perspective, using all the other tax advantage accounts available to you becomes essential. Strategy 4. Diversify away from employer stock. RSUs can easily cause your net worth to become overly concentrated in your employer stock, and that creates risk on multiple levels. Your career and your income are already tied to your employer. Holding a large portion of your investment in the same company adds even more exposure. If anything goes wrong with the company, you get hit twice. Once in your job stability and again in your portfolio. Diversifying away from employer stock isn't about pessimism. It's about balance. Selling your RSUs at vest and reinvesting in a broad, diversified portfolio reduces the volatility of your finances. It also creates tax planning opportunities in the future because diversified investments allow you to manage capital gains, harvest losses, and rebalance your portfolio more strategically. You simply can't do that when all your money is stuck in one stock. Finally, diversification gives your financial plan stability. Company stock can experience sharp swings that have nothing to do with your personal goals. By diversifying, you shift control away from market randomness and towards long-term growth. If you consistently owe money in April because of RSUs, increasing your withholding or make estimated payments. If RSUs push you into a higher tax bracket, increase your pre-tax contributions. If your company stock is volatile, sell your shares immediately at vesting. If you want RSUs to be a financial advantage instead of a financial headache, diversify and take control of the risk. And if you want to go even deeper, make sure you get your free copy of my equity compensation book using the link in the description. It's the fastest way to get clarity and avoid expensive equity mistakes. Thanks for watching, and I'll see you in the next video.